Let's take a look at using the infinite banking concept to purchase and control that flow of money for your buy and hold long-term rental properties. Now, we think owning real estate is one of the best assets that the middle class could own, especially in the investing environment. And so when we talk about whole life and banking, that's a savings conversation. And now what we're doing is we're bringing the world's most powerful savings account into an investing conversation like real estate. So let's assume we have someone that's going to put in $100,000 for 4 years into some type of checking account at a bank, and then $25,000 a year after that. And we're going to be looking at a 31-year time period. And let's assume this bank is paying us 2%. Now we know that's quite high in today's environments. So maybe we can assume this is a CD of some sort, which is why there's going to be taxes involved on that growth. So if we just let this checking account sit, we would have $1,427,738. Now let's go out and purchase a rental property using this account. And so we're going to go out and buy a $50,000 property. That could be the down payment. And we're going to pay cash for this. Now, a lot of people don't understand the ramifications of paying cash long term. And this is where the book Becoming Your Own Banker, written by Nelson Nash, is vitally important to your long-term wealth strategies, because he identified a problem in that book where he said you finance everything in life. You're either going to borrow money from someone else and pay them interest, or you're going to use your own cash and give up interest you could have earned. And so we call that an interest cost. And so we're going to be looking at that effect on this account. And so if we look at the end balance now, taking the $50,000 out to purchase a rental property, which should be producing cash flow, which is a great thing. If we look at the ending account balance now, it's $1,350,799. So if we subtract $1,427,738 from $1,350,799, the true actual cost of using that money was $77,939. It wasn't just $50,000. Because what's happening is, because you took out the $50,000 in the first year, that $50,000 could not compound at that 2% interest rate every year after that. And that is what we call an interest cost. And that has a very large effect on your cash long term. And so we're going to be looking at a couple different options on how to make this more efficient for your investing strategies, specifically around real estate. So let's change our thought process a little bit and start thinking like the banks. You see, banking is a conversation that centers around controlling and redirecting that flow of money. And so it's not an investing conversation. So when we start thinking like a banker and then start investing, you want that investing dollars or that cash flow to be redirected back to your original banking source. And so we're going to change this to like an 11.55% interest rate, which would mean there's about $6,000 a year or $500 a month cash flowing from that property. And all we're doing now is thinking like a bank and directing that cash flow back to our savings account that's earning 2%. And you can see by just doing that, our new ending balance down there at the bottom right is $1,575,743. So significantly better than the previous options of just leaving the cash in there and also paying cash. Point is, now we have a paid off rental property down here, as well as all of this additional money in this checking account. Now let's go even further and start doing what the banks actually do and not what they tell us to do. So banks are not keeping their savings with other banks, they keep it with life insurance companies. And one of the reasons why is that they earn a much higher rate of return on their savings. And we are going to be taking a look at that. Now, what you'll notice is the first few years, you're definitely behind the people that would have just kept this in a checking or savings account. And so this is where you really need to think long term. If you're only thinking 3 to 5 years in the future, this is definitely not the strategy for you. But if you can think long term, then this strategy is going to work very, very well for you. And so all we're doing is the same thing we were already doing, except long term our savings rate has increased dramatically inside this policy, but we also get to eliminate the government as our partner because there are no taxes involved with your insurance policy if you're using it properly. And so we get to eliminate the taxes from this equation, which has a very big effect on your cash long term. So now if we look at this, utilizing the policy loan feature, which allows you to borrow from the insurance company, not from your policy, you borrow against your policy, which means your cash always continues to earn interest. So you never interrupt that compounding growth. Therefore, you never have to give up your interest cost for your money. Now look at the difference this makes just through a 31-year time period. We now have $2,231,534 inside that policy. And by the way, that policy is tax-free. You can use this for passive income later. But I want you to look at the policy for what it really is the world's greatest savings account. Because at the end of this time period, 30 years, what you have now is a paid-off rental, which is going to increase your cash flow dramatically. And if it were me buying this property, I would be taking that cash flow to keep funding this $25,000 a year of, in this case, premium for the policy. Because in that 31st year, because of the compounding growth inside the policy, your account grows from $2,122,000 to $2,231,000, or it grew $84,000 above what you put in that year. So if you think of that as a passive income enhancement to what you're already going to be doing, you now have a paid off rental. If you just redirect and think like a banker to control that flow of money back to your banking institution that you now own, look at the effect that this will have. And each year that gets better and better. And so when people see this with one rental property, now the question is, what if we did 4, 5, or 10 rental properties through a system like this over a 30 to 31 year time period? You can imagine those results of what would happen if you ran more things through your banking system. And so the question I'll leave you with is, does a bank make more money when they're financing one thing or 5 different things? You see, the more they finance, the more money that they control and flows back into their life. And you have the option to do the exact same thing. So you have more control in your life, more certainty, and ultimately much more cash flow.